stock. Common stock is what we call shares that we own in a company. It is called common because it is the most common type of stock. Public corporations issue these stocks, and when you buy an individual company stock from a stock exchange, you're more than likely buying common stock. If you own a share or is common stock in that company, it means that you own a piece of the company itself. So you become an owner yourself. In the modern day, there are two ways of getting access to owning a common stock. One, through the primary market, IPO being the common example of that, or two, by buying through the stock exchange. The second option is the most common and the most easily accessible. And because everybody can buy these stocks of publicly traded companies from the markets, they have a price attached to it, which is determined by the forces of demand and supply in the market. Therefore, the price of a common stock can vary according to the stock market, the demand for that stock, sentiment of investors, the company's prospects, past track records, etc. Along with owning a common stock, the owner also receives some voting rights. So shareholders with at least one whole share or one lot of common stock possess the right to vote on certain business decisions at the annual general meetings of that company. By owning these common stocks, the owners are also entitled to dividends. A dividend is a part of the profit that the company pays back to its owners at the end of the financial year. And the entitlement and the amount of this dividend payment is proportional to the ownership in the company. Remember that I said entitlement. It is not a right. It is not a guarantee. So that means that as an owner, you can expect to get paid dividends in one quarter or 1 year, but not the next. It's an internal business decision which the CFO, CEO, and the upper management of the company will decide on. Say, this particular company that we own stocks in have decided that they would pay dividends. And this dividend will come after the bond payments are made, after the interest payments are made, after the preferred stockholders receive their dividends. If the preferred stockholders do not get paid, we as common stockholders do not get paid at all. So, common stockholders are the last in line for receiving any dividend benefit from the company. In other words, after everybody else has been paid off, only then can common stockholders qualify to receive dividends. To illustrate this point further about common stockholders being the last in line, let's say unfortunately our company gets into trouble, loses its profitability, and has to sell off its assets because it is facing bankruptcy. In the case of such a liquidation, where the assets of the company would be sold off into the open market, common stockholders are also entitled to some of it, but they would receive it last. That means the debt holders or the creditors would be paid first. So the bond holders, the commercial bank loans, would get paid first. Then come the debentures, then the preferred stockholders, and only then, last, the common stockholders would get their piece of the liquidated assets, assuming that there is anything left. This concept, or the notion that the common stockholders are the last in line and they will get paid after everybody else is paid off, is explainable using a fancier, more formal term: residual income. Common stockholders are entitled to everything from the residual income, and this residual income can be paid in dividends or retained within the firm. That means after all the obligations are met, some money is left over from the company's profit. So then the upper management of the company can choose to disperse some of that as dividend to their shareholders, or they can choose to reinvest that amount into the operation of the company for the next year. If it is reinvested, the investors do not get paid dividend. But then there can be a mix and match, a portion of it paid as dividend, the remaining reinvested. If it is reinvested, it is also called a plowback, and in accounting, it is called retained earnings. Because shareholders have a claim on the residual income, that means that there is no upper limit or there is no ceiling. That means that technically, the dividend can be as high as possible, as high as the management desires. But on the flip side, because it is not guaranteed, that means that in certain times, the shareholders may be forced to suffer zero income in terms of dividends. A classic example of a company not providing any dividends is Google. Well, today it is its parent company, Alphabet. So the company Alphabet, which owns Google, does not provide any dividends. It has not done so in the many, many years before, and apparently does not have any immediate plans of changing that. So just because a company does not wish to give dividends does not mean that it is a bad company. There are extenuating circumstances behind that. An important concept tied to the ownership of the common stock is the limited liability. Many of you may see a term attached to a company called the LLC. LLC means limited liability company. This is a term more commonly seen in the US. So the limited liability here means that the shareholders of the company are limited in how much they are liable for their investment. If that doesn't make sense to you, allow me to explain it with an example. Let's say you own shares in a pharmaceuticals company, and the company created a drug that ended up killing people. For this, the company, its scientists, its management have been taken to court and they have been found guilty. So you, as a shareholder of the company, are you liable for the mistakes of the company's management and employees? The answer is no. You cannot be held accountable because you are only limited in your liability in terms of your investment, not on the operation. Furthermore, let's say our company goes bankrupt and they owe a particular bank or a host of different creditors millions and millions of dollars. So the company has to face bankruptcy, their assets should be liquidated. Let's assume that the company has to pay off $200 million in debt, but they only have assets worth of $50 million. So let's say we went to the open auction market, everything is sold off, and we got the $50 million in cash, which has been paid back to the creditors. Our debt was for $200 million. There is still $150 million of a shortfall. Who's going to pay that amount? We are the shareholders. We are the owners. So is it going to come out of our personal fortune? Are we going to pay it out of our own pocket? The answer is no. The limited liability principle protects us from having to use our own personal fortunes to pay off for the company. This is an important concept which practically shields the investors from various dangers that come along with owning a company. All the examples that I gave you, this would not be the case if you are a proprietor of a firm, or if you had a partnership, you and your co-owners or partners ran the business. In all these examples, you would have to pay out of your own pocket. This is one reason common stocks are so attractive as an investment instrument. Owners of common stock are also entitled to something called a rights issue. The proper term for that is preemptive rights. Now, the preemptive right entitles the shareholder to maintain a proportionate share of ownership in the firm. So say, for example, we own 25% of all the shares of a particular company. So if the company chooses to raise additional capital from the market by issuing new shares, we will be entitled to buy 25% of the new shares. Why? because we already own 25% of the existing shares. As a result, we have the right to claim 25% of the newly issued shares. And here is the preemptive part. In the older days, these rights used to be issued in the forms of certificates, which give the shareholders the option to buy new shares, but in modern times, it is all very digital. But nonetheless, the shareholder has a brief window within which they have to decide. Depending on the market, depending on the country, it can be as little as 2 weeks or several months. Within that time period, the shareholders can choose if they want to exercise their right to buy the new shares, or they can sell those rights in the open market, or they can simply decide not to purchase the new shares and allow their coupons or certificates to expire. It is an individual preference.